Well, welcome to this video. This time we're going to talk a little bit about the accounting information system. Now, essentially what we're going to do is we're going to discuss how we record economic events. Now, a regular accounting course is going to get really involved with a lot of things called debits and credits. We're going to concentrate more on just how things are recorded, but not all the terminology. So we're going to utilize something called the accounting information system or equation, the accounting equation. And then that will help us understand at least how things are recorded, and then ultimately, how do we create financial statements from that? So the first thing we want to talk about is a little bit about the environment that we're in. The accounting world is regulated, if you will, by something called GAAP, Generally Accepted Accounting Principles. And the entities that back this up, I guess, is one word to use, is we have the SEC, everybody's heard about that. We have FASB and IASB, right? We also have the Public Company Accounting Oversight Board. Now, in addition, there is some emphasis on something called the IFRS. This is an international standards that lots of countries are starting to move to. Now, they all really look an awful lot like what happens in the United States. So our system kind of drives the engine on this, if you will. But GAAP decides what rules we can use when we're writing down and recording these economic events. Now, one of the things I will just want to let you know is that sometimes, many times, there are more than one way to do something, right? For instance, if you want to record inventory, the purchase of inventory, and then the use of inventory in production, there are probably 6 different ways you can do that. All of them are regulated by GAAP, so you can't make up your own way, but there are different ways. And of course, what this does is it creates some differences in the financial statements, obviously, because you're recording it differently. As long as you, as a company, always do it the same way, there's no issues. If you decide you want to change, we're going to have to let our investors, in particular, know why that change was made, and that information will be found in the annual report. So according to FASB, what kind of qualities are we interested in? Well, the first thing they talk about is relevance, right? So it has to be relevant. It has to be able to make a difference. So if the piece of information really doesn't tell us anything or is such a minor detail, for instance, we recorded $12,000.12, and really it should have been $12,000.15. Is that material? Is that a material error, right? So again, relevance means we have to be able to use it, right? It has to have some predictive value, right? We want to have some accurate information, right? We have to be able to confirm any numbers that we write down, right? But things have to be material, right? So the item is material when its size would likely make you change your decision as an investor or a creditor. Faithful representation means that the information accurately depicts what really happened, right? So this keeps companies from spinning, if you will, from a political context, spinning the information, right? To make it sound better than maybe it really is. So faithful representation means information has to be complete, right? You can't omit anything. Has to be neutral. That means it's not biased one way or another. and it has to be free from error. That is faithful representation. So if we think about the qualities then of information, right? What makes information useful, right? Comparability. We have to be able to make comparisons between other companies. A little bit earlier, I told you there's different rules of how you can do things will affect the financial statements. There are techniques when we know that there's a difference, and we'll always know when you're analyzing a company because the information is in the footnotes. But there are techniques where we can adjust the statements to make comparisons when two companies use different accounting standards, let's say specifically for inventory. Of course, the information has to be verifiable, right? We have to be, if an independent person looked at it, they would have to get similar results. We have to have the quality of understandability. It has to be clear and concise. Consistency. We have to do the same rules every single year. If we change, we need to account for that, right? We need to let people know that we've made a change. And of course, for information to be relevant, it has to be timely, right? Telling us today about something happened 3 years ago is not relevant information. It's not going to affect anything that I do today. I should have known it 3 years ago. So what assumptions do we make? Obviously, we have a monetary unit, right? It's the dollar in the United States, of course. But other countries use different, obviously different currencies. Now, if we all use the same accounting rules, then relatively speaking, when we start talking about ratios, a current ratio in euros, that number is not any different than a current ratio in dollars. It means the same thing. It's just in a relative speaking currency. Economic entity, right? We need to be able to separate these entities, right? Every economic entity can be separated and identified, even like within a corporation, right? We need to be able to separate. If you think about companies like General Electric, right? They have, obviously, they produce jet engines, they produce appliances, they have a long-term nursing home insurance division. We have to be able to account for all those different entities within the one entity. Periodicity, right? Basically, it just says, look, we're going to divide the business into periods, right? Typically, what is the period? It's a end of a year is the typical period. However, we will sometimes break that down into smaller units. Why would we do that? Well, we break our accounting into quarters because we need to pay taxes quarterly in the United States if you're a business. So quarterly statements will be created so that we can pay the tax bill. From an operations perspective, we may want to break numbers down into some monthly information so that we can make quicker kinds of decisions if we need to about the operations of the company. Now, the going concern idea is we have to assume that the business will continue on into the foreseeable future. So we don't incorporate any idea of finality for the business. So what are the basic principles? Historical cost and fair value, right? 90% of all the information that's reported on a financial statement is historical data. It's the data, it's the numbers for the day of value on the day that the event occurred. There are some assets that may be adjusted from time to time to their fair market value, right? That Very few of those. We don't want to get all wrapped up in all of those things, but there are some things, very few things, that are adjusted for fair value. Now, the full disclosure principle basically just requires us to disclose everything that would have made a difference, right? Anything that happens that would make a difference in this company, you need to report somewhere in the financial statements. And finally, we have something they refer to as the cost constraint, right? Essentially, these regulators, right, that set the rules, they weigh the cost the companies would incur to provide the information against the benefit, right? So they decide in the end, well, if something is so difficult to determine that it's very expensive to get the data, and the benefit of that is of minimal importance to investors, then they're not going to set a rule or a regulation that requires something to be done with that specific piece of information, right? So they look at this gathering of data and the expense, and they compare the expense of gathering and providing the data to the benefits of users of the data. So that is a very quick review, if you will, of the rules and how accounting is, at least how the quality of the data and information, how is that developed within the company. Look forward to talk to you soon.